Hi there, this is Victor here. Welcome to the Intelligent Research channel. Several subscribers asked me to analyze Bank of America stock to see if it's a great bank for long-term investing. At the time of making this video, Bank of America stock is down as much as 37% in the past 1 year. Because of the current banking crisis, many depositors have lost their confidence in many smaller regional banks. That's why most of the banks have dropped a lot recently. The important question is Bank of America stock safe? And is Bank of America stock undervalued right now? As you may already know, several major banks already fell because of the current bank runs and the current banking crisis. For example, the Silvergate Bank, also known as the crypto bank, already fell. The Silicon Valley Bank already fell. This is the second biggest bank failure in the US history. Central Bank also fell at the same time. Credit Suisse Bank in Switzerland also fell recently. Now it's being bought out by UBS. Now all the major banking stocks, including the biggest national banks, are down substantially this year. For example, if you look at the Dow Jones US Banks Index, you can see it's down 31% in the past 1 year. In the past 5 years, you can see it had a minus 3.46% annualized return. Of course, if you compare this US Banks Index with the S&P 500, you can see that in the past 5 years, this index had underperformed the S&P 500 substantially. And if we compare Bank of America with the S&P 500, you can see that Bank of America had underperformed the S&P 500 in the past 1 year. Also in the past 5 years, you can see Bank of America had underperformed the S&P 500 a lot. In fact, Bank of America did not make any money in the past 5 years. Warren Buffett's Berkshire Hathaway is the largest shareholder of Bank of America. Warren Buffett's Berkshire Hathaway owns about 12.9% of Bank of America. Of course, many investors like to copy what Warren Buffett invests in. So in this video, I'm going to talk about these topics to see if Bank of America is a great bank for long-term investing. You will learn about these topics: Bank of America's biggest risk, Bank of America's long-term prospects, Bank of America's stock valuation. I will talk about how to calculate Bank of America's stock's intrinsic value per share. And will I buy a Bank of America stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all members grow their stock portfolios to over 7 figures over time. With your support, we will be able to stay independent and create many excellent stock analysis and investing videos a week that will help you become a great investor. The link is in the video description. Take a look, let's start. First, I want to go over Bank of America's biggest risk. They are bank run risk or liquidity risk, interest rate risk, uninsured deposit risk, credit risk, and I will talk about whether Bank of America is too big to fail. This is from FDIC. According to FDIC, US banks were sitting on $620 billion in unrealized losses at the end of 2022. These assets have actually dropped a lot in prices because of interest rate hikes in 2022, but a lot of these debt securities are not sold yet. Banks still report their unrealized losses on their balance sheets. Banks have to report realized losses only when they sell these assets. So this is a very important part you have to understand. According to this article here, researchers at New York University found that US banks had 1.7 trillion of unrealized losses at the end of 2022. This from the Wall Street Journal. You can see these unrealized losses of 1.7 trillion is almost as big as the US banks' total equity of 2.21 trillion. If you look at this here, you can see Bank of America was the worst performer in the past 1 year compared to JP Morgan Chase, Wells Fargo, and Citigroup. So the question is, why is Bank of America the worst performer in the past 1 year? There are actually several reasons. If you look at this here, you can see Bank of America's most recent Common Equity Tier 1 ratio was at 11.2% in Q4 2022. After we adjust all the unrealized losses, you see Bank of America's CET1 Common Equity Tier 1 ratio would be the lowest at 6% compared to all other biggest banks in the US. And it's much worse than JP Morgan Chase, Wells Fargo, and Citigroup. If we look at SVB here, SVB Bank was the worst. Its entire CET1 ratio was pretty much at 0 if adjusted for unrealized losses. Of course, the biggest reason was that SVB took on too much interest rate risk, investing a large amount of short-term deposits in longer-term treasury bonds and mortgage-backed securities. So when interest rates started increasing a lot in 2022, SVB's long-term held-to-maturity securities prices dropped a lot in values. This one here shows Bank of America has the biggest interest rate risk and duration risk compared to JP Morgan Chase. In fact, if you look at this here, you can see Bank of America's held-to-maturity securities unrealized loss as a percentage to common equity is much higher than JP Morgan Chase and Wells Fargo here. This is from the most recent annual report. You can see that Bank of America had $867 billion of total debt securities by the end of 2022, $4.8 billion of unrealized losses in available for sale debt securities. Here's the most important part. You can see Bank of America had a whopping $109 billion of unrealized losses in held-to-maturity debt securities by the end of 2022. This shows that Bank of America has the highest interest rate risk compared to all the other biggest banks in the US. In response to the current banking crisis and to prevent more bank runs, US regulators recently introduced a new lending program called the Bank Term Funding Program. How it works is this: banks can actually borrow short-term loans from the Fed up to 1 year and use high-quality government debts such as US Treasuries and mortgage-backed securities as collaterals at par value instead of market value. This is actually very important because banks no longer need to sell their held-to-maturity securities at huge losses. This means Bank of America does not need to sell all these debt securities at huge losses. Bank of America can just use these debt securities as collaterals and get a short-term loan from the Fed at par value. Another risk we have to consider is uninsured deposit risk. According to Business Insider, Central Bank had uninsured deposits of 90%, SVB had 88%, JP Morgan had 59%, and Bank of America had 33% based on their most recent filings. So this means that uninsured deposit risk or bank run risk is very low for Bank of America. Right before making this video, US Treasury Secretary Janet Yellen made an important statement recently about US banks' uninsured deposit. She said, "Our intervention was necessary to protect the broader US banking system, and similar action could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion." If you look at these financials here, you can see Bank of America has around $230 billion of cash. In comparison, Bank of America has around $303 billion of short-term and long-term debts. Most of these debts are actually long-term debts here. The short-term debts are much smaller. And we're not even talking about Bank of America's available for sale securities and held-to-maturity securities, which are much more at $863 billion. Another risk we should look at is Bank of America's bad debts or non-performing loans as a percentage of Bank of America's total loan portfolio. If you look at these financials here, you can see Bank of America had net charge-off ratio of 0.26%, non-performing loans and leases ratio of 0.37%, and allowance for loan and lease losses ratio of 1.22%. All these ratios are actually very low. Going forward, I think we have to expect that Bank of America's net charge-offs and provision for credit losses will likely increase. This is because of higher interest rates, credit conditions that have tightened more recently, much higher interest expenses for consumers and businesses, very likely higher unemployment rates, slowing down in the US economy, and a possible recession. I want to show you Bank of America's historical net charge-off rates here. As of now, total commercial's net charge-off rate is at 0.11% compared to the peak of 1.28% during the 2008 financial crisis. Consumers' net charge-off rate is at 0.5% compared to 3.6% during the 2008 financial crisis here. US credit cards net charge-off rate is at 1.7% compared to 8.3% during the 2008 financial crisis. So all this shows that Bank of America's net charge-off rates will increase a lot whenever there's a large recession. This is the biggest credit risk factor we have to consider for Bank of America. This is another example here. During the 2020 pandemic here, you can see Bank of America had huge provision for loan losses. So expect Bank of America, like any other US banks, will likely have much higher loan losses if the Fed increases interest rates too much and if the US goes into a recession in the upcoming months. Right now, the big four banks in the US are JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo. These banks here have the most deposits and the most assets. They are the too big to fail banks in the US. Also, the big four US banks I just talked about are global systematically important banks. Obviously, the US regulators will not allow bank runs to spread to the big banks such as Bank of America and all the systematically important banks in the US. Bank of America has a lot of cash, $230 billion of cash, plus $235 billion of available for sale securities. In this banking crisis, I think big banks in the US will benefit the most. This is because many depositors will continue to move their money from their smaller regional banks to the biggest banks in the US such as Bank of America, Wells Fargo, JP Morgan Chase, and Citigroup. Banks are very different from traditional businesses that sell goods and services. Many of the traditional financial metrics actually do not work when we analyze banking stocks. For example, we cannot use gross margin, free cash flow, operating cash flow, and free cash flow to analyze banking stocks. Here are some of the most important metrics for banks. For example, total deposit growth, loan growth, provision for credit losses, net charge-offs, non-performing loans. Also, cash equivalents available for sale securities, held-to-maturity securities, unrealized losses, realized losses, net interest margin, efficiency ratio, return on equity, and return on assets. I go for some of these financial metrics here. Typically, banks have this business model here. Deposits are actually considered liabilities for the bank. Once the bank receives deposits, the bank lend out the money to borrowers. So borrowers get the loan from the bank. So the loan is actually considered an asset. The bank earns interest income from loans, US treasuries, mortgage-backed securities, and other debt securities. The bank also earns non-interest income from banking fees, asset management fees, investment banking fees, sales and trading fees. So once the bank earns interest income, the bank uses a portion of this interest income to pay depositors interest. And this is considered interest expenses for the bank. Of course, there are always bad debts, so the bank needs to include provision for liquidity losses every quarter. The bank also needs to pay non-interest operating expenses. After all these are paid, the bank will have earnings, and a portion of these earnings will go toward dividends and share buybacks. If you look at these financials here, you can see that Bank of America earns about 55% of its total value from net interest income, and 45% of its total value is from non-interest income. Bank of America needs to account for loan losses every quarter. This is called provision for credit losses. Provision for credit losses are cash reserves set aside as an expense by a bank to cover loans that are likely to default. If you look at these financials here, you can see Bank of America's total deposits actually decreased since the peak in 2021. Most of the big banks in the US total deposit decreased during this period, including JP Morgan Chase. When interest rates are high, Bank of America can benefit the most. This is because Bank of America can charge high interest rates to consumers and businesses, and therefore higher interest margin. Here's one example here. In 2022, when interest rates started increasing quickly, you can see Bank of America's net interest income actually increased a lot compared to the previous year. And if interest rates start dropping, we can expect Bank of America's net interest income will also decrease. Going forward, the Fed expects that its interest rate will peak at 5.1% this year. Then interest rate should drop to 4.3% at the end of 2024 and 3.1% at the end of 2025. This means Bank of America's net interest income will likely slow down a lot by the end of the year or next year. Another financial metric we have to look at is the net interest margin. The higher the net interest margin is, the better for Bank of America. Bank of America calls it the net interest yield, which is the same as net interest margin. At the time of making this video, Bank of America's net interest yield is at 2.22%. This is lower than the banking industry's 3.37% net interest margin for US banks that have higher than $250 billion of assets. The efficiency ratio is also very important because it shows how well Bank of America managed its non-interest operating costs compared to its total revenues minus provision for credit losses. The lower the efficiency ratio is, the better. If Bank of America has a lower efficiency ratio than other banks such as JP Morgan Chase, that means it's better managed. This is a list of the best banks in the US ranked by Forbes. The financial data here is actually from S&P Global Market Intelligence. Bank of America's return on equity is at 15%, which is lower than JP Morgan Chase. Common Equity Tier 1 ratio is at 11%, which is also lower than JP Morgan Chase. And efficiency ratio is at 65%. This is higher than JP Morgan Chase. Overall, these performance metrics show that JP Morgan Chase is better managed than Bank of America. I think this is one of the biggest reasons that JP Morgan Chase stock had outperformed Bank of America a lot in the past 5 years. But of course, past performance does not guarantee future results. Here's an important part I want to share with you. The big 4 banks in the US usually have return on assets at around 1%. In terms of revenue forecast, analysts expect that Bank of America's revenue will grow by about 5.6% in 2023, but the revenue growth rates are expected to be very low between 2023 and 2025. In terms of EPS forecast, analysts expect that Bank of America's EPS will grow by about 7% in 2023. The EPS growth is expected to be 6% to 7% each year between 2023 and 2025. I think we have to expect that Bank of America to have very low revenue growth and EPS growth going forward. And if there's a recession, we should expect that Bank of America's revenue and EPS will drop. I want to show you how to calculate Bank of America stocks interest right here. Here's an important part. Don't use a discounted cash flow DCF model to value Bank of America stock. The biggest reason is that Bank of America, like most banks, do not have consistent free cash flow growth. Also, bank's business model is very different from traditional business models. I think a much better approach is to use a price to book valuation model here. I'll show you how this works here. Bank of America's 5-year average price to book value is 1.02. In comparison, the current price to book value is 0.79. Bank of America's book value is at $273 billion. If we times $273 billion by 1.02 here, Bank of America's fair interest value should be around $278.46 billion for the entire company. If we divide this by the shares outstanding, Bank of America's interest rate estimate should be $34 per share. If you look at this here, based on my intrinsic value estimate, Bank of America should be very undervalued at the time making this video. Just to compare, Morningstar estimated Bank of America's fair value to be at $37 per share. So will I buy Bank of America stock? The answer is no. It's just my own personal preference. For me, I have to consider the risk as well as the reward. Personally, I don't think there will be a bank run on Bank of America. In fact, I think Bank of America has a lot of liquidity. If you look at Bank of America's balance sheet, the amount of cash Bank of America has, as well as the amount of available for sale securities. Of course, there will be other risks such as credit risk, but it's very hard to predict whether Bank of America will have more credit losses when there's a recession or when interest rates are way too high for a lot of the consumers and businesses to pay off their debts. We will only know how much loan losses Bank of America will have when there's a recession or when there's a large market downturn. Personally, I prefer investing in non-banking businesses that have great management, that have large economic moats, that have high return on invested capital, high return on equity, high return on assets, increasing earnings and increasing free cash flows over time. For example, I like to invest in Apple, Microsoft, Alphabet, Visa, MasterCard, and American Express over the long run. I like to buy pieces of outstanding businesses when the stock is undervalued. I like to wait until the stock is traded below its intrinsic value. To take advantage of this banking crisis, recently I bought more American Express shares in this portfolio here. Even in this market, this portfolio has done very well because I focus on the best businesses that are undervalued. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting the channel. This is Victor from the Intelligent Research channel, and I will see you in the next video.